Hi, this is Mike Maloney, and this video is a little unusual. I'm in California right now on a very short trip. I normally am in Puerto Rico, and I'm staying up in the area where I used to live, up in the Malibu Mountains, very close to where all the wildfires were and all of the big burn that happened recently. And the only place that I could comfortably set up and set a microphone up where I can get my face close to it and my computer is outside. So there's some fallen trees and wood chippers going and chainsaws, and there's some dogs barking in the background and stuff like that. So you might hear a few unusual noises. But I wanted to show you, we've been following the yield curve now for quite some time, and this is a very, very important indicator on what the future of the economy is. There's something called bond vigilantes. Bond investors tend to be sort of accurate in their herding patterns, their group predictions of where the economy is going. Tends to be fairly accurate. And this chart here from Bloomberg, this is as one part of the Treasury yield curve inverts, watch the others. And so this chart is very interesting. I'm going to come back to it later because it's harder to explain. It'll be much easier if I go over to the dynamic yield curve that we have been following on stock charts and show everybody once again. And for anybody new, I'm going to define everything. So if you understand the definitions, just hang in there with me for a second. But this blue line, this is the S&P 500 index, so it's the stock market's performance. And you see this incredible rise since the global financial crisis of 2008. This is the NASDAQ crash and so on of 2000. And this is the real estate bubble in here. And but the yield curve predicts when the stock market is about to crash. And here's the neat thing. On this chart, you can grab this little line and you can sweep it across the S&P 500, the stock market, and you can watch the yield curve. Now, the yield is the amount that you're getting paid for loaning the government your currency for 30 years or for 20 years, 10 years, 7 years, 5 years, 2 years, and 3 months. Now, somebody that loans the government currency for 30 years is usually not that sensitive or nervous over the short term. They're betting on the long term. And so they tend to sort of ignore, is there going to be a dip next month? Or is there going to be a dip next year? Are we in for a short-term crash or pullback? But they're loaning their currency for a very long period of time. And so if everything seems safe, the government doesn't have to pay investors very much to borrow their currency for 3 months or 2 years, but somebody loaning it to them for 30 years wants to get paid more. However, if it looks like something could happen in the economy that is bad in the short term, these people that are investing in these bonds hold back until the government offers higher and higher and higher levels of interest. And there are certain points in time where this inverts, where the short-term investors are demanding a higher level of interest to be able to loan their currency to the U.S. government than the long-term investors. And what's interesting here, this starts back in about 1998. So this is shortly after the long-term capital management crisis and the Russian bond default. These were events that almost brought down the world economy. And you can see here that the yield curve is sort of recovering from a flattening, where they're all sort of the same, or an inversion, where short-term yields are higher. But it's unusual to see it like this. And if I take this line here and start sweeping it across, you can see that this starts to invert. It goes flat, and then just before the crash, short-term rates are higher than long-term rates. There's a full inversion right there. And then the crash happens. So this predicted the crash perfectly. And we get back into a positive yield curve. This is a normal yield curve. Now you're going to see the 30-year freeze, and that's because Alan Greenspan eliminated the 30-year. So actually, the last section of that line from the 20-year to the 30-year shouldn't exist. So just ignore that as part of the yield curve. And then we go into the real estate bubble, and the stock market starts doing well, and we've got a positive curve, and it goes up and up and up, but then it starts flattening. For some reason, in 2006 and 7, bond investors loaning their currency to the U.S. government for the short term got really nervous. And this was when Ben Bernanke and everybody else was reassuring us that everything was great in the economy, nothing to worry about. But this is an inversion right here. And then just a few months later, we have a stock market crash, and it goes back into a positive curve. Now you're going to notice that the short end of the yield curve, the 3-month, just gets stuck down at 0.25%. That's because the Fed pegged it there. They buy as many Treasury bonds that are 3-month Treasury bonds to keep it within a certain range of percentage, and they wanted it at 0.25%. And then we've got a nice positive yield curve, but the bottom end again is being manipulated by the Fed, and then the Fed wants to raise interest rates. They stop their QE programs, and now they're trying to normalize their balance sheet, and they start lifting the interest rates. Now, they need, what's interesting here, this is remember that 3-month is manipulated by the Fed. And here we are today, and we have a slight inversion right here between the 2-year and the 5-year. Very slight. But remember, this is pegged by the Fed. If this was free market, and nobody else is talking about this, if this was free market like it used to be, and it was bond investors that were doing this, you would probably see the 3-month yield curve somewhere up here, and we would actually have an inversion of the 3, the 2, and the 5. And that says that there's a nervousness out there, that there's probably something coming. But the Fed is increasing this percentage rate here, and they're trying to get it up to they need it up over 5%. Because when the next recession happens, they need to be able to lower rates by about 5%. That's what they did last time. The rates were up at 5.5%. They took them down to 0.25% during the crisis of 2008. When this happened, they took rates from up around 4.5%, and they took them down to 0.25% to get us out of that recession. Well, they have no headroom this time. They're only up at 2.33% right now. And so they need to get that up to 5% to get us out of the next big crash that happens. But by doing this, by trying to raise it, they're actually going to invert the yield curve. This is what's interesting. Now I want to go back to that Bloomberg article and show you that chart, and show you that this is the pinching. This is the measurement of the spread between the 2 and the 10-year. This one is the measurement of the spread between the 2-year and the 5-year, and the white line is the measurement of the spread between the 3 and 5-year treasuries. And those are the ones that are nearing or at inversion right now, is just that white line. But look at how when these start to pinch and get down here, and you don't want the blue and purple line to go below the white line. This is a full inversion right here. You don't want that to happen. That's a bad sign that there's something coming in the economy. And then we have the global financial crisis of 2008. And look at what is happening now, this pinching of the yield curves. It's flattening. And now the purple line has hit the white line, so we've got this totally flat area. It's actually a very, very slight inversion. And this is a danger signal that there's probably something coming that's very bad in the economy within the next couple of years. It's just one more example of the warning signs that have been happening since the beginning of this century. We've been able to follow these things, but with the Fed manipulating the 3-month, that also drags down the 2-year and the 3-year by just a little bit. And so there would probably be an inversion of the 2 and the 3 and the 5 right now, and the 3-month, if it was free market. Now I want to show you a zero hedge article. Bad omen worsens, yield curve inverts for first time since 2007. Now, they've got a lot of charts in here, and some of them are very hard to read, so I'm not going to explain them. The one on Bloomberg and the dynamic yield curve from stock charts are good enough to explain those. Now I want to take you to a chart I just generated on stock charts and show you something else that is another warning that something bad could happen sometime soon. We've seen these tops in the stock market, and everything was going along fine for so long for so many people invested in the stock market, and then we've got all this volatility and these areas of panic, basically. But one of the things that's really important here technically is this is the 200-day moving average. So you take the last 200 days of the price, add each day up, and then divide it by 200, and you've got the average for that section of the last 200 days. This is the 50-day moving average, and basically it's the same thing, last 50 days of price action. So the plots on the end of this line, 200 days and 50 days, is the last 200-day average of what the price was doing and the last 50-day average of what the price was doing. And when the 50 is above the 200, that's saying that it's a rising stock market, and this is a good thing. When the 50 crosses below the 200-day, this is a bad signal. When the 50-day moving average is crossing under the 200-day moving average, it's generally a signal that we're going into a bear market, that there's some tough times ahead for stock market investors and potentially for the general economy. So anyway, that's my take on the yield curve and the moving averages of the stock market. And I just think that this is a time for caution. And so I urge everybody out there to learn as much as they can about this and protect themselves. Thank you very much for listening. We'll see you next time.